Quarter 2 earnings recap. We got Coca-Cola, Snapchat, Microsoft, Tesla, and Twitter this week for some of the prominent earnings that I was following. This is StockerFinance. I'm your host, David Scheuer. Make sure to follow me on Twitter at StockerFinance for more. We're going to go in order, so from Coca-Cola, and then at the end, we're going to do Twitter. There's some timestamps in the description if you want to skip to certain ones. So, Coca-Cola, it gets a little green arrow next to its name, and that's because Coca-Cola's earnings reaction was very positive, but it was also very surprising. That, as expected, really just atrocious earnings, but expected is the key word there. There was restaurant closures, theme park closures, lacking customer demand, as expected. Investors thought that this was going to happen. In fact, they knew earnings were going to be bad. That's not a surprise to anyone. In fact, this is some of the worst earnings experience since the 90s. Investors mainly focused on the future outlook, though. They wanted to know, what is the unknown? We already know right now the current situation is terribly bad for Coca-Cola. But we know the fundamentals of the company is good. We know that they're a strong, large company. They've been through recessions, depressions before. What is the future outlook? When are they going to recover and return back to this really strong and profitable company? Well, that was kind of the difficulty. And the thing is that although they didn't really give formal guidance, their CEO made a statement saying that the worst is behind them and it's only improvements from here. And they did give some reasoning for this, and I'm going to read that in a second here. Now, compared to Pepsi, as I talked about in the earnings preview, Pepsi has been investing in snacks, etc., released snacks.com. I think it's been doing a great job there. So it only saw 11% slump. Overall sales were flat, whereas Coca-Cola saw 26% sales slump, which is, just to show the difference there between the two. Coca-Cola is not in a great position right now, but apparently, according to them, the future has, it's only improvements from here. This is basically the worst it's going to get. And that's exactly what investors want to hear, especially when they already know that it's a bad situation they're in. So here is a little article from the Motley Fool, and I'm going to read some highlights from it. So it said, Coke took some aggressive cost-cutting steps to help protect profitability. Operating margin held steady at 30% of sales, and gross profit margin only fell to 58% from 61% a year ago. Given the shrinking revenue base, those metrics should be considered significant wins by Coke shareholders. And that is a good thing to know, that they are taking different maneuvers to cut costs and to, make the situation as least bad as possible. However, the finances were still a hard hit. During the early days of the global pandemic, free cash flow down by 40%, core earnings dove 33% to 42 cents per share. Management said the business is strong enough to weather that challenge, even if profits are now almost sure to decline for the full year. Coca-Cola's system remained agile in the second quarters. Executives stated in a press release they were highlighting the company's strong balance sheet and ample liquidity. Looking ahead, so this is what is really important and this is what really explains the stock's reaction. This is looking ahead part of this article. I think it explains it very well. So Coke declined to issue a specific growth outlook due to key question marks surrounding the global pandemic, but CEO James Quincey and his team did suggest that the worst is behind the business. To back up that claim, they revealed that the volume trends improved a 10% drop in June after falling 25% in April. That rebound has continued into July, with declines slowing to mid-single digits. Now, for investors, we're looking into the future, and that's great news for the future of Coca-Cola. So that's just a little explanation there for why Coca-Cola's earnings reaction, despite it being, its earnings really being pretty bad, that Coca-Cola's stock price actually reacted in a pretty positive direction. A lot of people were confused by that, and I hope this clears it up a little bit for the mindset of Wall Street investors. I hope this explains it a little bit, especially for beginner investors. Next up here is Snapchat. Snapchat had some really interesting earnings, and Snapchat gets an oof from me. That is because it was the opposite of Snapchat. It had great earnings. Everyone thought that they were really good. The numbers looked solid, but the stock price tanked. In fact, it tanked about 10% right away after hours. It was just atrocious to see that massive of a decline, especially when people were so confused that they beat revenue expectations. Daily active users were up, usage was up. However, it was another Coca-Cola situation of what investors expected versus what happened and what the future holds. The main thing that I saw here was a lack of transparency in this call. And this is something that actually bothered me. Now, I am a bullish on Snapchat. I've been, a long-term shareholder. I like Snapchat as a company. I think they're incredibly innovative in the social media space. However, they really lack transparency in this call, I felt. It just felt a little awkward. They provided terms of guidance, sort of. They just didn't really provide any guidance. They said some things about the future, but not much. They didn't really explain at all about their competition with TikTok. And they didn't really explain their increase in spending that much either. They said a few things about innovating, about augmented reality, but I want to know what big innovations are they going to be making into the future. Perhaps they just didn't want to announce that right now because it's not fully done, and they're just going to kind of shove it on their app when it happens so that, there's been a history of companies, let's say for Facebook, for example, copying and basically just stealing Snapchat's ideas and plastering it on their own platforms. So we'll see if maybe that's the reason they didn't want to fully be transparent during this earnings call and not give away any information, but we'll see what happens. We're going to look at the numbers in a second here, and let's actually just take a look at them really quick. So daily active users grew, which was great, but one of the key metrics here is that it didn't grow enough. People are stuck at home. Investors know they expected earnings to be really good for Snapchat. They're like, yeah, there's no way. People are stuck at home. They're going to be using Snapchat more. People are going to be downloading it. Once they can't hang out with their friends, they're going to be Snapchatting them. But guess what happened? Well, it didn't grow enough. Although it grew, it wasn't what investors expected. They thought it was going to be more than this, and they were kind of disappointed. And that's really what led to a big negative stock price reaction to this. Daily active users is a really key metric for these social media companies, and for them to disappoint on this metric is pretty significant. So although they grew their daily active users, it wasn't growing fast enough for Wall Street, and that's a big important thing that I want to point out there. Revenue by geography also saw a slight decline from Q1, but still beat expectations. And again, I want to point out with Snapchat that they really need to capitalize on the rest of the world in Europe. That's something that I hope they focus on in the future. If you look at the last slide here, where it's the daily active users, it's split into thirds, but the revenue is really only coming from North America. So they really need to capitalize on Europe as well as the rest of the world there to match North America's revenue, since the user amount is the same across North America, or just about the same across North America, Europe, and the rest of the world. So why aren't Europe and the rest of the world, making the same amount of revenue if they have the same amount of users? It doesn't really make any sense there. We'll see what happens with Snapchat. Hopefully they improve on that. Net income, they started spending a lot of money this quarter. Hopefully that's a good sign that they're investing for the future, as they were talking about in the earnings call, but it decreased pretty substantially from Q1. And that's kind of a disappointment, since it seemed before in the past that Snapchat was really on a trajectory to profitability. And now this quarter, they kind of took a sharp little U-turn. And that's not something we like to see as investors. We're on a clear path to profitability. Even if it's, a year from now or 2 years from now, we want to see it. We want to be able to see that there is a path to profitability. But right now, if you can't see that path, then it becomes a little sketchy and investors aren't sure what to think. And that reflects in the stock price. Oops, sorry about my phone going off there. Operating expenses also increased. And again, look, they're spending almost $300 million in Q2 on R&D. Hopefully something big comes out on Snapchat that proves this. I have heard they are teaming up with this meditation app, and I think they're actually going to be increasing or using developing some sort of app store. And I'm not really sure how to explain this. It's still kind of new, but it's an app store that would go into the texting on your iPhone or Android. We'll see what happens there in order for people to play games and connect with each other, especially during a time like this. That's important. So we'll see what happens. Hopefully that's what they're investing in. Hopefully it leads to more revenue and eventually profitability for Snapchat. That's really important. And here's growth, which explains a lot about just everything. We saw even though Snapchat's still growing, we had a decrease in the amount of growth. Cash flow turned negative again. Although it was, operating cash flow was positive last quarter, it really took a U-turn this quarter, and that was a pretty big disappointment in my opinion. So in my opinion, Snapchat struggles to keep people in the app for long periods of time. It's not really made for browsing like, TikTok, Instagram, and Facebook are, Twitter is, or even Reddit is. So it really needs to get better, and I think it could do this by implementing community game, the scoreboarding/ranking system, using augmented reality that they have to sort of, let people try on clothes and stay on maybe they could have people try on clothes, and through that they could purchase the clothes if it looks good on them. I think this could all benefit Snapchat greatly. And after, purchasing the clothes, Snapchat gets a cut of that. I don't know, just ways to improve profitability, or hopefully lead the way towards profitability and keep people on the app for more. So we'll see what comes for Snapchat. I know I've been rambling on for a little too long about Snap here. Let's go on to the next one. Microsoft. So Microsoft, not much of a surprise here. Honestly, not too much to say here. Microsoft earnings were great, and it was a pretty average. Although cloud growth slowed, which disappointed some investors, especially since it's competing against Amazon, Google, and even Alibaba, who are attempting to take more market share. I think Microsoft will really shine when people and students get back to work and school, as well as the release of the new Xbox. Although I still believe the PS5 will outsell the Xbox in my opinion, and it's full disclosure, I own Microsoft and Sony. It will be I also own AMD, which has chips in Microsoft in the Xbox and the PS5, which is huge. it will still be a major revenue driver, and Xbox have plenty of loyal fans. So the rate of cloud growth really just needs to see some improvement in the next quarter, in my opinion. It's still improving, but I think it just needs to pick up the pace a little bit. And that's something that investors are a little disappointed in. So Microsoft gets a nice little blue equals sign, since it wasn't bad, it wasn't great. They still, they beat earnings as expected, as Microsoft does almost every quarter. Revenue was a beat as well. We saw 38 versus 36.6. Sales grew by 13%. Earnings grew by 7%. And however, it was the company's slowest earnings growth in 8 quarters, which is a big disappointment. We also saw some small downgrades from analysts after the earnings announcement. Cloud growth, again, it's not just growing fast enough. And this is another case of the known versus the unknown. And that's something to really keep in mind when we're talking about earnings season. What do investors already know, and what do they not expect that might happen? So you really got to take that into account when analyzing companies' earnings, especially if you're going to be betting on them at all. Tesla. So Tesla was huge earnings. This was probably the most anticipated earnings all week. Some of you probably just skip forward to hear what I have to say about Tesla here. Now, some of the biggest thing is the new Cybertruck Terafactory in Austin, Texas. In fact, there's so much to unpack for Tesla. I almost think I should make another video on it, and to be honest, I might. But I'm going to give a quick recap and summary and try to do this the best I can. So again, Tesla announced the new Cybertruck Terafactory in Austin, Texas. It destroyed analyst expectations on all fronts. It was profitable for 4 quarters in a row now, which proves that Tesla is basically recession resistant, possibly recession proof. However, the topic of EV tax credits was a little unsettling to some investors, and it really kind of ignited some of those Tesla Q people. And Tesla heavily relies on those for profitability, but they're also increasing, especially throughout Europe. Oops, sorry about that. Where, the world really wants to transition, especially in China and Europe, to, EVs. And there's a lot of encouragement for that. So I don't think these tax credits are necessarily going to go away anytime soon. I know there is some deadlines on some of these, but I don't think it's going to affect Tesla negatively too much, especially just with the massive monopoly it has on the electric vehicle market right now. It's not a complete monopoly, but it basically seems like it as of right now. It's just so far ahead of other automakers. Sorry, my computer's glitching out a little bit. I also think the massive run of the stock up to earnings was partially why there wasn't a pop, despite a great earnings report. And that's kind of true. Another thing is that the S&P 500 conclusion is pretty much for sure now, and it'll be interesting to see how a stock reacts to that. All in, I'm just super happy with Tesla's performance. They were also talking about the Tesla Semi ramp up. They're talking about the further ramp up of current gigafactories and vehicles, etc. So woo, go Tesla. Let's take a look at the financials here as well, though. Vehicles delivered. We see the Model Y having a huge increase in deliveries, which is awesome. Model 3, it was better than Q1, which is awesome as well, especially during the time that we're in right now. Revenue grew from Q1 as well, which is great to see. Revenue and operating income and gross profit, as you can see there, 4 quarters in a row of being fully profitable. That is awesome for Tesla. Again, you can see it right here, especially during the times that we're in. This is so difficult to do that, and it's just great to see this for Tesla. So good job for them. Margins are also increasing, which is great to see, especially as their factories start ramping up more. Operating expenses, we saw operating expenses actually decrease a little bit, which is great to see. And one of the huge things, we're seeing growth decrease a little bit. It's not a bit too big of a deal there, but one of the biggest things that I want to show you guys here is the cash they have on hand. They have a crazy amount of cash on hand, nearly $9 billion of cash on hand. That is an incredible amount of cash, and I think a lot of that is going to be used for building the new Terafactory in Texas, as well as finishing the project that they're currently working on. They got a lot of cash to work with here, and that is great to see for Tesla. So, anyways, not too much else to say on Tesla, just a brief summary. Let me know your opinion on it. It was a pretty anticipated earnings. But again, the earnings reaction was kind of negative to Tesla. Or not the earnings, sorry, the stock price reaction, which was kind of interesting. And I think part of that was just that there was such a massive run-up to earnings that when it happened, again, it was, we already knew all this good stuff. We kind of expected an announcement of a new gigafactory. A lot of people expected a lot of this good news. And so it really wasn't much of a surprise. And so I think that's part of it. There's just so much hype and this huge run-up that it basically, the surprise that people were expecting, I think it happened before earnings. It just happened. It did a pre-earnings reaction, basically. And I think that's pretty much all that happened here. There was some, some FUD going on, some negative news reports on Tesla that drove the stock price down a little bit, but not too much. It's still, year over date, the stock price has risen an insane amount. And they still have S&P 500 inclusion coming up. It's really super interesting to see how the market reacts to that. So we'll see what happens in the future for Tesla. Now, Amazon, oops, I accidentally thought it was the 23rd. My bad. There's some conflicting information. It's actually July 30th. So I'll see you guys next week to talk a little bit on Amazon. If I don't make a video about it, which I probably will, follow me on Twitter at StockerFinance for sure, because I'll definitely be tweeting about Amazon earnings. Might even live stream it. We'll see what happens, though. Twitter was a super interesting earnings report. So they had a loss per share of 139 adjusted, which was really interesting. It's kind of hard to compare to the expected earnings because it weighed down by 1.1 billion loss related to a non-cash deferred tax asset. And sorry about that. We're going to go ahead and look at the numbers here. I'm going to explain what a non-cash deferred tax asset here is a second. Their revenue was $683 million versus $707 million expected. Pretty negative there. Monetizable daily active users increased to 186 million, but again, it's kind of expected. People were at home. More people are using Twitter. It expected 34% growth year over year, which is the highest ever since the start of reporting this metric, which is great to see. Now, here's the problems intertwined in social media, also known as PISS. No, I'm just kidding. It's just Twitter problems. I'm going to talk about that after we go through the numbers here. So we saw a pretty big jump in monetizable daily active usage, which is great. But again, it's not too much of a surprise to investors. And that's why I think, again, it was just people weren't really surprised about this to Twitter. And because of mixed in with some of that negative earnings as well, due to lack of advertising revenue for Twitter, we saw the stock price decline in terms of a reaction to the earnings report. Revenue and operating income. Well, we saw operating income go negative this quarter. Not a great sign, especially since they've been profitable so many times in the past year for the past, quite a few quarters here. And then to have a massive drop like this was not something we'd like to see for Twitter. The margins also just plummeted out of control to an below negative 150%, which is not a good sign as well. Operating expenses, they decreased from Q1, but they didn't decrease enough to improve that margin at all. If we go to growth, again, it's declining, although it is, it's just their operating expenses are growing year over year, but their revenue is decreasing in growth year over year, almost negative 20%, which is not great to see. And although advertising, had some negative effects on Twitter, I think there's a lot of just political stuff that Twitter's getting involved with, a bunch of different things that are affecting them really negatively. I think they really got to reevaluate their situation as a company and just get everything under control a lot better. Cash flow, we saw capital expenditures again, just completely, not too much to say there. Anyways, cash and short-term investments, we saw a little bit of an increase in that. They still got a lot of cash on hand, which is a good sign for Twitter. So anyways, here are the real Twitter issues going on. We got revenue issues and we got politics. The big thing with politics is they took out all those political ad spending, which for Twitter is huge. That's a huge revenue source. And I won't be surprised if Facebook, or if not Facebook, at least Snapchat and maybe the other apps start taking advantage of this political money, and they're going to benefit from that instead of Twitter. So Twitter's going to basically have its competitors benefit from this. It might not be morally correct. I know there's a lot of morals around this. People have problems allowing political people or parties to advertise on Twitter. But again, as a business, that is a huge hit to its revenue, especially during election season right now when so much of that spending could be going to Twitter. But instead, advertising across the board is down and they're not allowing that type of advertising spending. It's not looking too hot for Twitter right now. And next quarter, I don't think it's looking too hot either, in my opinion, especially again with this big security breach that happened with the huge hack. That wasn't a great sign. So to talk about a deferred tax that I spoke about a little bit is a non-cash item. So it's not represented in the cash flow under the direct method. And this is a definition straight from Google here. Any increase in deferred taxes or decreased in a deferred tax liability is subtracted as part of the adjustments to net income. Now, hopefully that summarizes a little bit why it wasn't really compared on this page to expected earnings. If you're someone who has no clue what I just said, don't worry about it too much. Basically, Twitter is just in trouble. I am sacrificing my battery life here, guys, for you. We got to get through this video. Here, though, is an interesting, I think just a super interesting, okay, good. Sorry about that. Here's a little article from Markets Now. This is from CNN Business. It says it says it's looking at subscription options as ad revenue drops sharply. And this is something I just wanted to kind of highlight really quickly. So their CEO said they're exploring additional ways to make money from its users, including a subscription model. Jack Dorsey said Thursday, the move comes from as Twitter suffers a sharp decline, as I was talking about, in the advertising business. So we're going to see some tests this year for the subscription model, and I'm super interested to see what happens about this. It's going to be really interesting. And, the shares of Twitter rose 4% early trading following earnings results because, again, we saw, people expected it to be bad and it did worse. But again, Twitter's in a weird situation right now, and the stock price since declined since that short rise in earnings or in its share price. It's hard for me to explain. I'm probably gonna have to just make an entire separate video on this and go a lot more in depth since this is just a summary video. Anyways, thanks for watching. Subscribe, check out these videos, as well as follow me on Twitter at StockerFinance for more. I will see you guys in the next video. Peace out.